Will the Kotak Platinum Plan help you create long term wealth? Let us find out the answer to this question through an in depth analysis in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to make the right financial and investment decisions to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand a few basic details about it. So, some of the key features of the policy are: this policy increases your wealth with a low cost plan, and you can get multiple investing options to choose from, and you can also improve your long term wealth creation through survival units, and you get to select a policy with flexible premium payment terms for your convenience, and there are rider selection to improve protection, and you can also take advantage of liquidity by making partial withdrawals. And there are three variants of investment strategy in this policy, like self-management strategy, age-based strategy, and systematic switching strategy. And there are also various fund options you can choose from, like classic opportunities fund, frontline equity fund, Kotak mid-cap advantage fund, balance fund, dynamic bond fund, dynamic floating rate fund, dynamic gilt fund, and money market fund. So all these fund options are categorized here based on the percentage of allocation each fund option has to certain asset classes like equity, debt, money market, and also according to the risk profile it has been categorized. So each fund option can vary from aggressive to conservative and moderate and secure. So you can choose fund options based on its asset allocation and also what kind of risk profile it aligns with your risk tolerance. And there are benefits like partial withdrawal, maturity benefit, death benefit, and tax benefits. And there are various charges also, like premium allocation charge, policy administration charge, fund management charge, switching charge, partial withdrawal charge, discontinuous charge, mortality charge, miscellaneous charges. So the ULIP policy, they also charge you various aspects. So you need to take this into consideration before deciding to invest in this policy. And if you want to know more about these aspects of the policy in detail, you can refer to the policy brochure. Now let's move on to understanding the advantages and disadvantages of investing in this policy. So let's start with the advantage. This policy is a unit linked plan, which means it provides both life insurance and investment opportunities, and this policy allows you to pick between three investing techniques in order to develop a sizable corpus after the policy term ends. And it also provides access to 8 investment funds with risk return profiles ranging from conservative to aggressive, and you can choose an option with easy payment terms. And this policy also allows for partial withdrawal after the 5-year policy period to solve liquidity concerns. The disadvantages, however, are there is a 5-year lock-in period, and before the payment is invested in your chosen fund option, there are several fees like various charges it will be deducted. And the systematic switching strategy is not accessible for premium payments made quarterly or monthly, and while switching between funds is still a possibility, each approach requires the adequate time required to execute and return provide high returns. And the life insured in this policy bears the investment risk in the investment portfolio during the settlement term, and during the settlement period there is no life insurance or other advantage such as partial withdrawal or transferring between funds which are available. So these are all the drawbacks that you need to keep in your mind before deciding to invest in this policy. Now, as we have a basic understanding of the policy, let us move on to the analysis part of the video, where we are going to analyze the IRR of this policy, internal rate of return, to help us make an informed decision on whether the returns we get in this policy is sustainable in the long term or not. So for calculation purpose, let us assume that a 35-year-old male purchases this policy with a sum assured of 15 lakhs, and he pays an annual premium of 1,50,000 for 20 years, with being the policy term and premium payment term same. Now we are going to calculate the IRR, internal rate of return of this policy, based on two future assumed rate of return, 4% per annum, 8% per annum, just to indicate how this policy can perform in two scenarios, like worst and best case scenario. These are not guaranteed returns, and they do not indicate the only maximum and minimum returns this policy can can give, because the actual returns will be based on various factors including the future policy investment performance. This is just to give you a glimpse or an idea about how this policy can perform in two different scenarios. Now we have calculated and taken this benefit illustration example based on the policy brochure, and we are going to calculate the IRR based on the online return calculator given in the policy website. So in the 4% scenario, in the worst case scenario, the IRR comes around 2.20%, which is similar or even lower than a savings bank account rate of interest. So if you have not invested your money anywhere and just kept it in your bank account, it would have still given you better returns or at least similar returns. So there seems to be no value addition for investing in this policy, but this is for the worst case scenario. In the best case scenario, 8% per annum, the IRR comes around 6.15%. So 6.15% is similar to debt instrument like FDs. So this return is also not giving us the better risk adjusted return which we would expect from a risk oriented product like a ULIP policy, because we are taking that kind of risk and we are investing for a long term period, and still it's only giving us returns similar to a debt instrument. But as this policy, despite being a ULIP policy, is not giving us a desirable outcome that we need, now we are going to calculate or compare this returns from this policy with other alternative strategy to conduct a comparative analysis. So here what we are going to do is, in this alternative strategy, instead of investing in insurance plus investment bundled up in one policy, we are going to invest in the insurance and investment separately just to see whether it can give us better outcomes and work efficiently separately. So for calculation purpose, let us assume for life cover purpose, we have purchased a pure term policy where the premium is only 7,800 rupees per annum. So the policy term is 20 years and the remaining balance amount we are going to invest in PPF, which is actually low risk government backed scheme giving you guaranteed returns. So here our investment is going to be 1,42,200 rupees per annum, which is the balance remaining amount compared to the Kotak Platinum Plan premium where we paid 1,50,000. So the current interest rate in PPF is 7.10% without risk. So as you can see in the tabular column, the Kotak Platinum Plan, after taking the risk in the worst case and in the best case, is only giving us returns which range from 2 to 6%. On the other hand, if you invest the money in PPF, then the IRR will be 6.65%. So with taking risk in the Kotak Platinum Plan, it only still gives us 38.01 lakhs in the worst case scenario and 59.50 lakhs in the best case scenario. But in PPF, without taking any risk, it gives you a guaranteed 63.12 lakhs for 20 years, so which is even slightly higher compared to Kotak Plan, and it is guaranteed. So for a fair comparison, now we are going to compare this policy returns with another risk-oriented product just to see whether it can give us better risk-adjusted returns in the long-term period. So here also we are going to invest in a combination of pure term insurance plus ELSS mutual fund. So ELSS mutual fund, especially which is predominantly investing in equities, as you can see, for a long-term period, if you choose to invest in it, from the track record, as we can see, it has even outperformed its benchmark of 12% average return in certain cases if you choose to invest in it for a long-term period. So let's see, the assumed return rate in ELSS is 12% with risk. So let's see how it performs. So as you can see, the IRR in the ELSS is 10.79%. So if we invest 28.44 lakhs for 20 years, we will get 1.04 crores post-tax. And if you have any doubts regarding how the ELSS tax is calculated, you can see that we do have a small tabular column presented on the screen for your reference, which you can pause and see. So now what do you think? Which one is better? Kotak Platinum Plan or PPF plus term insurance combination, or ELSS plus pure term insurance combination? So what is the final verdict? Should we invest in Kotak Platinum Plan or not? So if we evaluate this plan with its advantage and disadvantage, what we understand is this plan will be a disadvantage for you. Also, if we compare it with other investment plans, as you can see that it is advisable to ignore this policy. If you don't want to take any risk, you can actually choose PPF plus term insurance combination. But if you want risk in your investment portfolio, then you can choose to invest in equity mutual fund plus term insurance combination for a much better result. But investing in this policy is definitely an avoidable thing, so don't invest.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.